Hey there, I hope you and your families continue to stay safe and healthy. I'm here today to talk to you a little bit about a big picture. The big picture I want to talk about is the capital markets and how they have performed all the way back since 1934. I think it's a very, very important time to have this conversation to create context and an understanding of what's happening in the market today, what the similarities are from the past, and what the differences are. And the main point of this video is to help you understand that there are far more similarities to what's happened in the past and now than there are differences. So I'm going to take you through a very quick slide showing you how the markets performed, what events have happened between then and now, what the sentiments were at those times, and where we are today, to give you a much better understanding of how the markets have performed and how we expect they'll continue to perform going forward. So what you'll see in this slide is that starting in 1934, $1,000 was invested. And the point here is to demonstrate that over the course of the years from 1934 to 2019, different markets have performed differently. There's been greater or lesser volatility in different markets, but ultimately what would that $1,000 have been had the investor not touched that money between now and then? And the important thing to realize is twofold. One is that every single asset class that you could hold is worth significantly more in real returns, so that's after inflation. The second thing to note is that there are, and I've circled all of them here, a many number of events between then and now that have occurred that at the time felt like they probably were as serious or as dire as our conditions are currently. And some of those events include World War II, the Cold War, Korean War, the Vietnam War, Arab embargo crisis, the Gulf War, Black Monday, the Cold War ends, dot-com collapse, 9/11, the Iraq War, US downgraded to AA quality debt, the US subprime debt crisis, and the Eurozone crisis. So all of those were very large-scale events globally and had massive impacts. And at those times, it did in fact feel like it may have been the end of capitalism or the end of whatever world existed at that point in time. However, what we do notice is that at the end of that period of time, every single asset class is up, and in spite of the volatility, the market had continued to grow. And that's something that we expect to continue to occur going forward. So that's why it's really important to have context when you're thinking about making investment decisions and not just reacting based on emotions. So one thing to take away from this is to understand that the markets are cyclical. They do have ups and downs. We do not know generally what the event is going to be that's going to cause the next market decline. However, we are fairly certain at this point that we will always see market declines or market corrections or even recessions roughly every 6 to 8 years. And if we understand that and build an investment portfolio tied to timeframes and goals, as well as take advantage of the fact that when the market is down, it can be a buying opportunity if your circumstances are correct, then we don't ever have to worry about these market cycles. So if you yourself have a great financial plan and a great investment strategy, then this current market cycle is of no concern to you. If you do not have a good financial plan or a good financial planner working with you, then this is a great opportunity to seek a second opinion, and we would be happy to work with you on that. So if you or somebody you know has questions and they want some answers, please reach out to us by email. We'd love to take a few minutes to talk to you over the phone. And if you have any questions that you would like us to address in an upcoming video, please reach out and let us know. We'd happy to do that as well. Again, I hope you and your family continue to stay safe and healthy, and we'll talk to you soon.